Welcome, everyone, to What Business Loan Can I Get? I'm Jerry Detweiler, Education Director with NAV.
And I am Ty Kiesel, Content Director at NAV. It's great to be here.
We're so glad you're joining us. Today, we're going to help you understand what kinds of business loans you may qualify for based on your current qualifications. And then we'll also give you an idea of other loans you may qualify for in the future if you improve some of your qualifications. So we want to reach you where you are right now in your business, as well as where you may be going in your business. We'll provide some alternative ideas for challenging situations. Maybe you have a newer business, maybe your credit is on the mend, maybe your revenues have been hit by the pandemic. We will provide some options there. We'll give you some resources that can help you on your financing journey. And then finally, some next steps and specific steps you can take. Make sure that you do check out the resources attached to this webinar as well.
I think the place to start is to talk about what lenders are looking for. They're going to ask you lots of questions, and there will probably be focused on, what are your revenues? How long have you been in business? And what does your credit profile look like? Basically, they're trying to determine if you have the means to make periodic payments, if you are inclined to do it, if you will make those payments, and if you'll be able to continue to do that regardless of the outcome of the particular financing. So as we go through some of these qualifications, ask yourself, is this demonstrating that I can repay a loan, that I will repay a loan, and that I'll be able to do it throughout the entire course of the financing?
But let's dig in a little deeper because I know sometimes these criteria can seem a little vague. So we want to get as specific as we can for you. So let's start with revenues. At NAV, we're a marketplace. We work with lenders of various types across the country. And so we get an idea of what these lenders are looking for in terms of the customers that they want to offer financing to. And when it comes to revenues, most of them are going to look at business bank account activity. And most of them are going to look at your average monthly revenues. Sometimes they'll look at 3 months, but lately we've been seeing a trend toward the past 6 months, especially coming out of the pandemic economic crisis. They're going to look at sort of the trends in your revenues as well. Are your revenues dipping? Are they increasing? Are they pretty steady? Those kinds of things will give them some insight into those questions that Ty was just mentioning. Another thing that many financing sources for a small business look at is the deposits going into your business bank account. How many are there? How many deposits are going in each month? What are the different sources of those? And here, what they're looking at is they want to make sure that you are not overly dependent on a single client or a single source of income for your business. So that if 75% of your business comes from one particular business or client, and that went away, your business would tank. That's what they're really looking at there. They'll also look at the number of low balance days, and the low balance varies depending on the lender. But if you have the ability, and I know this isn't always possible, but if you can park, say, $500 or $1,000 or even better, $2,000 into your business bank account and pretend it's not there. Don't touch it. Don't go touch it. Go into that part of your balance. If you can do that, that is helpful because they'll have a different cutoff for what a low balance is, but they'll look at the number of days where you dip into a low balance. They'll also want to see how many days you have non-sufficient funds or negative balances in your business bank account. Try very hard to avoid this. Now, sometimes it's not avoidable because cash flow is an issue, which may be why you're looking for financing, but sometimes there are things you can do about it. For example, trying to invoice your clients more quickly, follow up on invoices that are past due, provide incentives for your customers or clients to pay more quickly. If you operate some sort of cash business, getting to the bank where you can deposit those checks or cash as quickly as possible, as opposed to saying, well, I'll get there next week. In the meantime, I have a overdraft line of credit. Try to keep above that zero balance on your bank account as much as possible. They may also want to know how many business to business invoices invoices you have outstanding, and that's for something like an invoice factoring type arrangement where they will advance you based on the invoices you have outstanding to other businesses, or they may ask questions about collateral, which could play a role in what you can qualify for. Overall, the one thing I want to emphasize here is that a business bank account is absolutely a must. You must have a business bank account, and please run things through that business bank account. So, an example would be, and we saw this with some of our NAV customers at PPP, where they have a PayPal account and they're receiving payments through PayPal, but they aren't depositing that into a business bank account. They're using PayPal almost as its own bank account. I would recommend that you deposit that money into your business bank account. So you have one central place that all that money is going into, and that could help you qualify for additional or for financing and qualify for more financing.
Yeah, there are a lot of lenders, Jerry, that if you don't have a business bank account, that will put the rejection stamp on any loan application just at that. So, yeah, I 100% agree with everything that Jerry has just said. Time in business is also a factor. And when I consider time in business, I'm thinking of the track record that you're demonstrating to a lender that you will repay a loan. All the different lenders that we're going to talk about today have different time frames. But generally speaking, if you've got a year or two in business, that's kind of the minimum for a lot of lenders. However, after the pandemic, some lenders have increased that to 3 years. Traditional lenders like banks usually will even want more than that, but the time you have in business matters. So, what my suggestion is, once you've decided, if you're a new business and you've decided to start your business, even if you haven't started taking money yet, go to the county clerk and register your business name and get started, because that's when the clock starts ticking. So that a year down the road, when you start generating revenue and you need and you need a loan, for example, you'll have that year in business that you can look back at. But definitely time in business matters. Jerry, do you want to talk about credit scores, or do you want me to do that?
Yeah, I'd be happy to. Credit scores are also important, and there are some credit flexible options that we will talk about in this presentation. So if your credit scores are not strong, we have options for you, but we really encourage you to be working on your credit continually, because strong credit scores do open a lot more options for you. So on the personal credit side, many of these financing sources or lenders will check credit, and sometimes they will require a credit check for multiple owners. SBA loans, for example, require a credit check for any owner with 20% or greater ownership. When they do check credit, it's not uncommon for lenders to be looking for a personal credit score in the 650 plus range. There are some that are more flexible though. And you'll especially find with many online lenders that they may be willing to go to a lower credit score if the revenues and other factors justify it. So you can shop based on your credit, and of course, we'll give you some resources for doing that. In addition, some lenders may use business credit. So they may use the credit report or business credit scores, or both. So sometimes they're just looking for red flags. They just want to see, are there collection accounts, unpaid tax liens, judgments, UCC filings, things that they may use as a warning sign for doing business with that particular business. But other times they're looking at credit scores. And so they want to see a good business credit score in order to approve the application. Now, there is a credit score called FICO SBSS, which is just for small business. And this credit score can pull in credit data from the owner's personal credit as well as from business credit, the business credit report, and analyze both sets of data to come up with a single credit score. If you haven't heard of FICO SBSS, we do have a detailed article about it on the NAV blog, just nav.com/blog, type in FICO SBSS and you'll get more information. Currently, NAV is the only place to see a FICO SBSS score as a business owner.
Can you go back to that slide for just a second, Jerry?
Sure.
You should know as a business owner that even though it doesn't require perfect credit to get a small business loan, if you have less than perfect credit, you can get a loan. But there is a direct correlation to your qualifications and how much the financing is going to cost. So if you have a 750 or a 780 credit score, you are likely to get a better interest rate and more favorable terms than someone else applying for that same loan with a 600 score or even less than a 600 score. So the lower your credit score, the higher the cost you should expect to pay. And, at some point, banks like to see credit scores in the 700s. So if you have a 600 personal credit score, some of those options that are offered at the bank won't even be available to you. So it's imperative that you spend time looking at your credit scores and what is your credit profile look like and making improvements wherever you can. And even though you might not be able to do it overnight, regular actions that will encourage that improvement over time will help you. So just be aware that it does matter. Also, the industry that you're in matters. Whether it's the SIC code or the NAICS code, those are both codes that kind of identify what your industry is. And if you're looking at a lender, many lenders have industries that they prefer not to be a part of. So if you're in the wrong industry, you might get declined just because of the industry you're in. Also, some industries are considered higher risk than other industries. So you need to kind of be aware of what this looks like. And you can get a view into that with a free nav account. You'll be able to see what industry you're in, what industry you're categorized in. And then if it is the wrong category, you can reach out to the credit bureaus and make sure that it gets corrected.
So, first things first, we're going to go next into some very specific types of financing and the general qualifications so we can deliver on the promise of this webinar, which is what types of business loans can I get? But first things first, if you do not have a business bank account, please open one and please use it exclusively for your business expenses and income, and have all the business income go through that business bank account. This is going to help you in your qualification. Make sure you have a specific time in business. Again, Ty mentioned that if you are incorporated, then it's very clear. This is the date you incorporated with your state. You formed your LLC, whatever it may be. If you do not, if you're operating as a sole proprietor, which is not ideal, but we know that many businesses do, then at least, like Ty said, get a business license or register your business name with your state. You can do that as what's called a fictitious name, or DBA, doing business as. And then check your business and personal credit and monitor it on a regular basis. And we'll give you some tools for doing that later in the presentation.
There are a lot of, we're going to start talking now about the things that are available. The SBA is a great source of borrowed capital for those businesses that actually qualify. The 7A is the most popular loan type. There is the express loans, microloans, 504 loans, export express. These are all loans that will help small business owners that have good to excellent credit get the lowest interest rates at the most favorable terms. They're available at the bank. The SBA is not a lender. They work through member banks. So if you want to apply for an SBA loan, you'll go to the bank and apply. Also, at the local bank or the regional bank or whatever bank you go to, there are lines of credit available, term loans, and commercial real estate loans. And if I could wave a magic wand and qualify every small business in the world, I really am a huge fan of community banks because they offer these products that really benefit small business owners. And we'll talk a little bit more about the differences between some of these products in a minute. Banks, however, prefer to lend in larger loan amounts because it costs them roughly the same to underwrite a $50,000 loan as it does a $500,000 loan, banks are going to be more inclined to work with businesses that are looking for the $500,000. As small business people, you understand that. Basically, banks are looking for solid business fundamentals. They want at least 2 years, depending upon the bank, in business. They're going to want to see that your business is profitable. And so they're going to look at your financial statements to determine that. I spoke with a lender one time who said, if I can tell more about a small business's finances by looking at their financial reports than they understand, I'm not going to offer them a loan. So make sure you understand what your financials are. And they usually are going to require a business plan. What are you going to do with this financing? If you get it, how is it going to increase your business? They're also looking for good credit. So they will do a credit check of your personal credit, and they're going to want to see something over 680, but they prefer in the 700s. So you're going to want to have good personal credit as well as a good business credit profile at the bank. And usually the bank will require some kind of collaterable asset, some specifically identified collateral, a personal guarantee. And, those are things you should expect if you're going into the bank.
So Ty mentioned SBA loans, and as he mentioned, with the exception of disaster loans, which the SBA does issue directly, they don't issue loans, they guarantee loans. So you go to a lender that's been approved by the SBA to get one of these loans. Now we have this short guide to SBA loans that we've uploaded as a resource for this presentation. So if you're interested in this, check it out. You do have to be a small business. You generally have to have good credit. Lenders' requirements vary. The SBA just says acceptable credit, and the lenders will have their own requirements. And then generally, they're trying to make sure these loans are available to small businesses that couldn't get similar credit elsewhere. It's known as the credit elsewhere test. Don't worry about that too much. Your bank or lender's going to figure that out and make sure you qualify. But they are trying to help small businesses that are generally underserved. And I think we'll see even more and more of this coming out of the pandemic, where the SBA's focus is really going to be on trying to help businesses that have trouble accessing capital, but who are likely to be able to repay the loan. Remember, SBA loans are guaranteed by the SBA, and ultimately, who guarantees that? It's us, taxpayers. So they have to make prudent lending decisions, because if someone defaults and they can never collect, it comes out of taxpayer dollars. They do typically require collateral and a personal guarantee. Collateral is not a reason for turning down an SBA loan, but if it's available, you will have to pledge it. And that's generally true of loans of $25,000 or more. So the one tip I want to give you that's most important about SBA loans is, just because you've gone to one lender and they said we can't make a loan for you doesn't necessarily mean you can't go to another lender. It may be that particular lender's appetite for that loan, their qualifications. It may not be that it's SBA requirements. So you can always ask them, if they say no, is this an SBA requirement, or is this something, what's behind it? Or should I, can I look elsewhere? And very often you can look elsewhere.
Some of the products that I think you need to understand the difference of are a line of credit and a term loan. I am a big fan of lines of credit because you get a limit and you can borrow what you need up to the credit limit, repay it, and then borrow it again over the course of the credit line. Interest is only charged on the amount that you borrow. So you're not paying interest through the term of the credit line based upon what your limit is, only what you use. And the ability to quickly access capital without reapplying for more money, as long as you're within the credit line, is very convenient. This is probably the most popular way small businesses have traditionally accessed borrowed capital. A term loan, on the other hand, is a fixed amount of money with a fixed repayment period, and it's if you're borrowing $10,000, you get it immediately and you start making payments immediately. It's predictable payments generally, and it's good for specific projects, like maybe you're expanding into um, a new location for your business, or you're purchasing equipment or something like that. A term loan is a really good option for that. Um, Lock and term loan requirements are a little bit different. They're going to vary. Um, Traditionally speaking, to qualify for a line of credit requires a little bit better credit profile than a term loan, because they're borrowing based upon what you may or may not use over the course of the term, but they're going to want to see 1 or 2 years in business. Traditional banks offer locks, as do online lenders, and those qualifications are going to vary. The minimum revenues may also vary, so you're going to want to explore what those are. They're going to probably look at your personal and business credit, and the minimum scores may vary. You should expect them to want to see mid 600s credit score for a lock. Now, some term loans, they'll go a little bit lower, but you should expect about a 650 credit score to be the average that they're looking for. Now, banks will offer the lowest rates, but online lenders will be able to give you an answer faster and often tend to be a little bit more flexible.
Another product that is popular with business owners who need money very quickly is the cash advance, merchant cash advance or business cash advance. And what this is it's essentially a purchase of your future receivables. So if you're a business that has a lot of transactions going through your bank account, or you accept debit and credit cards in your business, so a nail salon, a dentist office, a retail store, then they will look at the past activity and they'll advance money based on future revenues. Technically, by law, it's not considered a loan. It's considered a purchase of future receivables. And very often, these financing companies will give you about 50 to 100% of your average gross monthly revenues. So remember, we talked about your monthly revenues before. Average it. Don't take the best month. Take the average for the last 6 months. Sometimes it's 3 months. And then multiply that number by, 0.5, or look at that number, and that gives you the range of what you may be able to get with this kind of financing. Now, you may be able to get this kind of financing with as little as 3 to 6 months time in business if your business is making money. So it would be a business that hits the ground running, has a lot of revenues coming in. You may be able to get that advance. They typically are not that concerned with personal credit. They often will check it. It's usually a soft credit check, which means it doesn't impact your credit scores, but they have very low credit score requirements. So we're talking mid 500s, low 600s, etc. But then when you get this funding, and you can get it very quickly if you qualify, the money to repay it will come directly out of your business bank account or your merchant account. So next time your customer swipes their credit card, or next time a client deposits the funds into your bank account, a portion of that goes to repay this. It does tend to be fairly expensive, and it can be quite expensive depending on the terms. So it's something you need to really think about and evaluate against other offers that you might be getting. But it is a pretty credit flexible type of financing.
Business credit cards are one of my favorite options for new businesses, because it's going to help. If the business card reports to the business credit bureaus, it's going to help you build business credit, and it's going to give you a line of credit that you can use as you need it. The reason I like it is because the barriers to entry for a new business are much smaller. The decision about whether or not they're going to approve your credit card application will probably largely be based upon your personal credit and income from all your sources. So your you're more likely to get approved for a business credit card, particularly if you have good to excellent credit. Um, Credit reporting is often done to the business credit bureaus, so you're going to be able to build your business credit at the same time. Now, you're going to want to check with the particular card to make sure that they report to your business credit. However, some cards, if you default on a payment, will then report that default to your personal credit bureaus as well. So not only would it hurt your business credit profile, but it could hurt your personal credit score and your personal credit history. You can the NAV free account will allow you to see your personal credit scores as well as your business credit reports. You can go to nav.com /reports or nav.com/business reports to get that information. And I would invite you to do that. I think I've had a relationship with one of the bureaus for many, many years, and I review my personal credit history every month. And there are times when something pops up that looks out of place so that I can go in and fix it, as it's human nature for us to impact the metrics that we pay the most attention to. So just following that is really important.
Another type of financing that may be appropriate for certain businesses is called microloans. Now, you won't see a lot of microloans advertised widely because they're usually made through smaller organizations, including nonprofit organizations like Community Development Financial Institutions, CDFIs, which are nonprofit organizations usually focused on economic development in a very specific geographic area. So they're, for example, maybe trying to increase jobs and small business in a certain city or a certain county or a region of your state, etc. So they're not out there advertising, they're smaller nonprofits, but they can make loans that may be very crucial to certain businesses. The loan amounts are often small. There's no official limit, although the SBA's microloan program the limit is $50,000, but usually we're talking in the range of anywhere from $500 to $50,000. Now, these may be startup friendly, so you may be able to get a microloan if you have a brand new business, especially if it looks like you will be impacting jobs in the area in which you're building that business. They may be credit flexible. So if you've been through some issues and you can demonstrate that you're rebuilding your credit, they may be willing to overlook that. I think that'll be especially important post-pandemic for businesses that were really impacted by the coronavirus crisis. And then they usually come with something called technical assistance, which means they're going to try to help the business be successful. That might be mentoring, counseling, educational programs, etc. A few examples of places you can look for these loans include your CDFIs, SBA, the SBA Microloan Program. Kiva.org offers 0% loans to businesses for up to $15,000 in the US. There's no fees, no interest charge, but you do have to repay the loan. Axion is another microlender. And the way to find microloan programs, in addition to the NAV blog, where we've written about these extensively, if you just go to, again, nav.com/blog and type in microloans, you'll find several articles about them, including a directory of CDFIs around the country. You can also go to your SBA resource partners. So that would be your Small Business Development Center, SCORE, Women's Business Center, etc. And they often know what's going on in the community and what programs might be available. So check out your local resource partner through the SBA as well.
Another great option for newer businesses are vendor terms or trade lines. Suppliers that offer maybe it's a net 30, net 45, etc. It's not a small business loan, but it's allowing you to access your vendor's capital for 30 days or 45 days or 60 days. They often typically are not only low cost or no interest if you pay them early, they will give you a discount on the merchandise. I've I've known small business owners that have used that discount to help augment their payroll. So this is a great way to get a little bit of borrowed money that you can over time use. And I think you'll find that your vendors will be the most friendly creditor that you have because they want you to succeed almost as much as you do. Typically, if you're a good customer, they're not going to do a credit check. They're not going to dive into your financials too much. They just want to work with their best customers. And the thing I like about it is that if they report to the business credit bureaus, and you should inquire as to whether or not they do and encourage them to do if they don't, it will help you build business credit. You can find vendors that specifically report, that we know report, at nav.com/vendors. And this is a great way to start building your business credit. Speaking with an Experian executive a few years ago, after the 2008 financial crash, they were following new business startups. And I think it was in about 2010. And he said that the successful businesses 2 or 3 years after the economic crisis all had one thing in common. They were using vendor terms from their suppliers.
That's a great example. And just to be clear, because I did get this question yesterday, what are trade lines? What are vendor terms? It's basically an account where you're buying something you need in your business, but you're paying for it later. So rather than having to pull out the credit card or write a check, they are letting you get what you need, supplies of some sort for your business. For a restaurant, it could be food, coffee, wine, beverages. For a manufacturing business, it could be part of the things that go into manufacturing the product that you have. For a construction company, it could be lumber, concrete, things like that. And then they let you pay for it later. So that's the essence of what that is. And it's a great form of funding for many businesses. Now, another one we want to touch on is crowdfunding. Crowdfunding has seen remarkable success through the pandemic, and it continues to grow. There are four main types of crowdfunding. One is rewards. This is the Kickstarters of the world, and this is where you offer some sort of reward. For example, an early version of your product, or a T-shirt, or something tangible to customers who back your campaign. Debt-based crowdfunding is where you're getting money lent to you by the crowd, by people who want to support your business, and you're going to pay that back, hopefully, with some interest to those who invested in your company. Equity-based crowdfunding is where you get investors, and this has had some very favorable changes recently. The Securities and Exchange Commission has raised the limit from $1.07 million recently to $5 million. And they've made some really positive changes that let businesses even test the water before they go live with their campaign to find investors through these online platforms where people can invest in your idea. And then finally, donor based. This is the GoFundMe's of the world, where someone is donating money to your business. Less common for small business pre-pandemic, but during the pandemic, we did see success for businesses through donor based crowdfunding. But really, what I would focus on for most businesses is rewards, debt, or equity crowdfunding. And this could be a really good way to get money for your business. It can be very startup friendly because there are campaigns for brand new businesses. There are lots and lots of platforms online that will help you find supporters, and they don't care what your credit is. Your credit is not a factor. Generally, if you are successful, it's pretty cost effective, but it does require good marketing. And you've got to have a good photos, good video, good compelling reason for people who are on that platform to back your campaign. And you're probably going to have to start with the people you know. Very few campaigns do not get funded without some initial investment by friends and family. Sometimes it's majority friends and family, but sometimes they just start the ball rolling. So that's going to be very important. And developing a social media following can help as well. It may be taxable if it's rewards-based crowdfunding, so keep that in mind, and it can be time-consuming. There is a cheat sheet available for free at crowdfundbetter.com. I recommend it because what it's going to do is it's going to lay out the different platforms for the different types of crowdfunding so you can get a better idea of what's out there and find the one that might be appropriate for you. What I love about crowdfunding is that it could be a stepping stone to financing. So we talk to a lot of startups at NAV who are not qualified yet for financing, but if they can get that revenue going and get those fans backing their company, then they become financeable. They are able to show the revenues then that demonstrate to lenders that they can pay back their financing.
Another type of financing that is really beneficial is equipment financing. Depending upon the nature of your business, there are probably things you use that will qualify for equipment. And it doesn't have to be big industrial equipment either. The chairs and tables in your restaurant or the computers you use, anything that is an asset that is tangible could be considered equipment. The credit terms are very flexible, and actually they're beneficial to you because the lender or the leaser is going to use the equipment you're getting as collateral. So interest rates are sometimes lower than a term loan of the same size. And I like equipment loans because it can free up cash for those things that you are unable to access borrowed capital for. So it's a great way to get a little bit of extra cash flow if you need the equipment. There could be tax advantages. You're going to want to talk to your accountant. It may require a down payment, so you're going to want to consider that. But I'm a big fan of equipment loans and leases.
Yeah, they can be really advantageous to many small businesses. So, overall, what we've talked about is some different types of financing, and there are others. There's 44 different types of financing out there, and many lenders. So, we're giving you some general guidelines to help you understand the landscape. But ultimately, it's going to boil down to matching your qualifications to the financing that is available. And if one of these factors is not strong, your credit scores aren't strong, then the others should be. In other words, if your credit scores aren't strong, you should have good revenues. If your credit scores aren't strong, you have just started your business and you don't have any revenues, you'll be more limited in your options. Then something like crowdfunding might be a better fit. But do understand that, as your business grows, you want to work on all three of these pillars in order to make your business as attractive as possible to different lenders. And so we do want to touch on the different types of financing that might be available if you are challenged in one of these areas. So if you have a new business, you might look at business credit cards, equipment leasing, vendor accounts, microloans, or crowdfunding. All of those may be available to you as a brand new business. If you have low credit scores, cash advances, which are very revenue focused. I should also add that invoice factoring and invoice financing may be available in that category as well. Equipment leasing can be more flexible on the credit scores. Vendors often don't look at the personal credit scores at all. So the reference that Ty had earlier on the slide, nav.com/vendors, those vendors don't even check personal credit. So you don't have to worry about that there. Microlenders may be more flexible. If you have low revenues, vendor accounts might be an option because those suppliers want you to do business with them as opposed to someone else. Microloans might be an option, and that would, again, low revenues is probably also a newer business, or business credit cards may be available to you if you have good qualifications on the personal side. So in other words, the revenue doesn't have to come from your business to qualify for a business credit card. It could be personal revenues that help you qualify. But hopefully this will give you some ideas of what might be out there. And we want to share some resources to help you find these lenders as well.
NAV has a lot of resources at nav.com to not only help you get matched to financing, which basically what we'll do is look at the current condition of your business and offer financing that is appropriate to where you are right now. In other words, we'll match you with lenders who are likely to approve your application. But there's also lots and lots of valuable information on how to improve where you're at now, improve your credit profile. There are free and paid accounts to help you do this. And, I can't stress enough how important it is to monitor your credit in order to build a strong profile.
Yes, and I do want to make it clear that NAV is not a lender. We're a marketplace, and we match you to lenders using your data. So when you sign up with NAV, we're not going to sell your profile to lenders so that you get bombarded with phone calls from different lenders. We may reach out to you to help you if you need financing, but we will instead use the platform, use the technology to match you to lending options. And then when you see those options in your marketplace, dig a little deeper. You'll see a details button there where you can find out why we're matching you. Most of these are not full guaranteed pre-approval. So you want to make sure that you do meet what other qualifications the lender may require. And then we do have a team that's happy to talk to you, no pressure, and walk you through your options depending on where you're at. And I also see we have a question. We'll answer those questions in just a moment before we wrap up. So if you have a question, use the questions button to ask your question. Now, we work with pretty much all the major credit card issuers, and we have business credit cards as well as personal credit cards in the NAV marketplace. And using our Match Factor technology, we found that our customers who use Match Factor are 3.5 times more likely to be approved for a business credit card. So if you're in the marketplace for a business credit card, if that's something that you're interested in, then your NAV account and NAV's Match Factor tool can help you narrow that down so you can shop for the right credit card.
So how do you get started? Review your business financing profile with NAV. It's free. It doesn't cost you anything to have us take a look at it and see what kind of matches you can get. See what financing options you currently have in your NAV matches, and then you can make decisions about whether or not it makes sense for you to continue with the application process and apply or monitor your financing profile while you work on your qualifications, because where your business is today isn't necessarily where it has to be 6 months or a year from now. We can help you improve so that if you do get a loan today, we can help you get a better loan tomorrow. And if you don't qualify for a loan today because of your credit profile or whatever, we can help you prepare to qualify in the future.
Yeah, so thanks, Ty, for that wrap up. Let's go to questions. We do have a question. Is a real estate investment company considered a small business? And the short answer is yes, it is a small business. So now what the types of financing that may or may not be available may vary because of the industry that you're in real estate investing. And I'm not sure what structure of real estate investing you're doing, whether it involves commercial real estate, but I'll just give you a couple of ideas here. On the commercial real estate side, there are commercial real estate loans. The SBA has the 504 loan program. So if you were to have a property where you're going to own or occupy at least 51% of it, that percentage is higher for new construction, then you may be able to get a SBA 504 loan. There's also some SBA loans that can be used to renovate existing properties in your business, or to expand the property that your business owns and provide some improvements to that property. And then we also have business owners who will use credit cards. So this is often in the fix and flip world, where they'll use a business credit card that doesn't show up on their personal credit. They will, take care of the improvements to the property. They'll sell it, they'll pay off the credit card, and then they'll do it again without impacting their personal credit. So that's another option that some of our NAV customers have found useful. Now, another question we have is, can I get a business credit card with 0% APR with my EIN? Now, I will tell you that, first of all, yes, there are some business credit cards with 0%, but all of the major business credit card issuers do require a personal credit check and a personal guarantee. The exception is there are some of these new cards, like, and I'm speaking off the top of my head here, so please don't take these as actual qualifications, but like Divvy and Brex, where it's a corporate card for businesses with pretty strong revenues, where there's not a personal guarantee, and that may be an option. So we do have cards like that in the NAV marketplace as well. And again, because I'm talking off the top of my head here, I don't want to say that specifically which one has which, but there are some cards like that now that are they're more aimed at a business that wants it as a cash flow tool as opposed to a long-term financing tool. And those you may be able to avoid a personal guarantee, but you probably won't be able to extend it for a year of 0% interest. With a 0% interest for a year, you're probably looking at a business credit card where you will end up having to have a personal guarantee, and they may or may not report to your personal credit. Okay, great questions, but we're up against our time. Thank you for joining us, and we hope you'll check out our other webinars, and we hope that we can be useful to you as you go along your financing journey. Thanks so much for joining us.
Thank you very much.